A 23-year-old with no finance degree, no six-figure salary, and no Wall Street connections quietly builds a six-figure investment portfolio before turning 30, while someone 10 years older is still trying to pay down credit card debt. That's not a rare case anymore. It's becoming the norm. Something has fundamentally shifted in how younger Americans approach money, and it's creating a surprising reality where Gen Z is, in many cases, building wealth faster than Millennials ever did at the same age. The question is not just how they're doing it, but what they're doing differently, and whether that advantage will last. To understand this shift, you have to look at timing. Millennials came of age during the 2008 financial crisis, a period that crushed job prospects, delayed earnings growth, and made investing feel risky or even irresponsible. Many millennials spent years just trying to stabilize their finances, focusing on paying off student loans and surviving rising living costs. Gen Z, on the other hand, entered adulthood in a completely different financial environment. While they faced inflation and economic uncertainty, they also grew up during one of the longest bull markets in history, and, more importantly, during the explosion of financial technology and access. Apps like Robinhood and Acorns didn't just make investing easier, they made it normal. For Gen Z, buying stocks or ETFs feels as routine as ordering food online. There's no intimidation factor, no gatekeeping, and no minimum balance requirements. This accessibility has completely removed the friction that once prevented younger investors from getting started early. And in investing, time is everything. Starting at 19 instead of 29 can mean hundreds of thousands of dollars more by retirement, simply due to compounding. Another key difference is mindset. Gen Z doesn't just save money, they optimize it. They are far more likely to track their FICO score, automate contributions to a 401k, and take advantage of employer matches from day one. They've grown up watching financial content on platforms like YouTube and TikTok, where personal finance has gone viral. Concepts like index funds, Roth IRA contributions, and dollar-cost averaging are no longer niche knowledge, they're mainstream. This constant exposure has created a generation that is not only aware of financial tools, but actively using them much earlier in life. Income strategy is another area where Gen Z is pulling ahead. Instead of relying solely on a paycheck, many are building multiple income streams through freelancing, content creation, or digital businesses. The gig economy has evolved into something far more scalable, especially with AI tools reducing the barrier to entry for side hustles. A Gen Z worker might have a full-time job, a freelance income stream, and passive earnings from investments all at once. This diversification accelerates wealth building in a way that wasn't as accessible to millennials when they were starting out. At the same time, Gen Z tends to approach investing with a blend of aggressiveness and awareness. They are more willing to take calculated risks early, allocating money into growth stocks, ETFs, and even alternative assets, while still maintaining long-term strategies. Many are prioritizing tax-advantaged accounts like Roth IRAs, understanding how future tax-free withdrawals can significantly boost their net worth. They're also more comfortable using automation, setting up recurring investments that remove emotion from the process and keep them consistent regardless of market conditions. However, this advantage doesn't come without risks. Easy access to investing can also lead to impulsive decisions, especially with trends like meme stocks or speculative trading. While millennials may have been more cautious due to past economic trauma, Gen Z sometimes leans into speed over strategy. The real differentiator will be whether this generation can maintain discipline as markets become more volatile and economic conditions shift.